Welcome to the class on leveraged buyouts, or LBO. This is a very interesting topic. In my conversations with students, it usually comes up as one of the more attractive and interesting topics for students. It's also fairly advanced. It'll incorporate everything we've learned in this class. It'll use your corporate finance knowledge, and I'll be fairly involved in Excel. So you'll get to practice your Excel skills quite a bit. With that, let me turn to some introductory slides. You can sit back and listen for now. I'll talk for 15-20 minutes, and then we will jump into Excel together. Just as heads up, we'll be using the model we've built in prior class, in financial modeling class. And I'll be modifying that model for LBO assumptions. So let me switch to slides. I have just a few introductory slides. So starting with uses for LBO model, where is this analysis going to be used? It's an important tool for private equity firms when they look at their acquisitions. And the core of LBO is IRR metric. So we'll spend a lot of time modifying the model, but at the end of the day, we are trying to calculate internal rate of return for a private equity investor. They have their own hurdles. They change with the states of the market, but typically it's 15 to 30% range. IRR depends on the amount of leverage. Leverage is, as the name itself implies, is very important to this analysis. So basically, as you'll see, the private equity firm will try to raise as much debt as they can for the acquisition, and they'll have to finance the balance between the purchase price and the debt that they have as their own equity. So the bigger the leverage, the higher the rate of return, as we will see. For a private equity firm, the leverage itself, we're saying it's important, but it's decided by debt providers, by banks. So it's really kind of an input into the LBO analysis, and it's also input into private equity analysis. It's not determined by a private equity firm. In terms of modeling, as I mentioned, the LBO model relies on the standalone 3 financial statement forecast. So that would be the basis. And it's, in a sense, it's very similar. We will be adding new tabs. We'll add sources and uses tab, which is really specific to LBO, and probably the main new thing you'll learn today, because you've learned 3-statement financial model in previous classes. And the key thing in that sources and uses page is that sources must equal uses, and we'll talk about more what's in them. So uses is what the money is going to be spent on. So it's cash paid to target shareholders, plus any debt recapitalization. And sources would be the debt that the private equity firm raises and their own equity. So here's an example of transaction price calculation, and then how that feeds into the uses. So typically, let's say for Home Depot, since it's a public company, their price is typically determined as a premium to the market share price. You know, on the background, there's a lot of analysis and consideration that goes into determining the purchase price. So it's not as simple as just multiplying the current share price by a percentage. So you would apply, if you were analyzing the deal, you would apply DCF, comparable company trading analysis, precedents. But at the end of the day, once you decided on the purchase price, it's very easy to express it as a premium to the current share price. And that's what we'll use in our transaction assumptions. So let's say Home Depot will be bought at 20% premium to its current share price. And we call that bid purchase price. And then if you multiply that by number of shares, we get to equity purchase price. And then we add debt, subtract cash to calculate enterprise value. And we back into the implied EBITDA multiple by the purchase price. For private companies, it's kind of reverse logic. You would assume a multiple. You would kind of value the business based on the multiple of EBITDA. And then you can back into share price, if that's even applicable for private company. So the key number in that table on the left is the equity purchase price. That goes directly into uses. That's the main use. You can see that on top of the uses table, and then we'll add up existing debt and transaction fees to come up with total uses. And then in Excel, going to the next page, we will kind of manually make sources equal uses. Basically, in LBO scenario, a firm has to come up with financing that's equal to total uses, right? It needs to come up with the money to pay all the stakeholders. And the way to think about sources, how do we come up with the money for LBO? You start with debt available. The top line here is cash, so sometimes you could use cash from the target, if it had excess cash. But if you recall in our analysis, when we built the model, we already assumed that we will use all the excess cash. The interesting thing here is that we will assume the date of this deal to be the end of fiscal year 2020. So we'll assume that the deal happens on January 31st, 2021, which is 4 months from now, which probably makes sense. It takes time to close the deal. But what it means is that we will rely on balance sheet information that we've kind of forecasted. As of January 2021, we don't have actual financials, so we'll use what we have in our model as of that date, right? And as of that date, our cash does not include any excess cash. So we'll keep that at zero. But then all the other lines here until sponsor equity would be debt that sponsor would have to raise. And the way companies usually think about the amount of debt is based on multiple of EBITDA. And for EBITDA here, we'll look at 12 months EBITDA before the closing. So this will be fiscal 2020 for Home Depot. So I kind of assumed 4 times for term loan, 2 times for senior bonds, and 2 times for unsecured notes. In the order I listed these debt tranches, the riskiness of the debt increases and seniority declines. Basically, if in a liquidation scenario, if the deal, if the acquisition was to be unsuccessful, the term loan holders would get paid first, and then senior bond holders will get paid, and then unsecured notes will get paid, and then at the end, equity providers will be paid, right? That's called capital structure. And as you as you go down in the seniority, you can see in the interest rate that the interest increases, right? As the debt becomes more risky, you have to pay more. And for unsecured notes, we introduce PIK concept, payment in kind, which has 8% rate higher than for other types of debt. But what payment in kind means is that the company does not pay interest every year, but the interest gets added to the principal. And then the lenders would earn interest on that PIK interest. But it never, for the first few years, it never gets paid out. So it's, again, it's riskier for that reason. And quite typically, the unsecured notes would come with warrants, which is basically claim on equity. And here we assume that they'll get paid 3% on sale of Home Depot at the end of the leveraged buyout. And that'll create some kind of interesting changes in the cash flow statement, because interest is not cash. Typically the way interest works, we assume that it's paid out, so it's cash. So here we'll have to have a non-cash item for PIK interest. For now, the main thing again is just conceptually, we determine the price as a premium to the current share price, calculate equity value that goes into total uses, which are equal to total sources, and then total sources are pretty much all the debt available, and then you subtract. So here, sponsor equity is the difference between total sources and all debt available for the transaction. So this was one tab that we'll build together, sources and uses. Now I'll talk about the second new tab called Pro Forma Balance Sheet. It's basically balance sheet as of the date of transaction, adjusted for leveraged buyout changes. So the main things here, they're purely financial. You'll see kind of in the middle column here for adjustments, we will not be adjusting for operational items such as inventory or accounts receivable. We just want to adjust for what happens during the deal, and kind of the impact is instantaneous, right? So we assume that transaction closes on January 31st, 2021. So the day before, it was old balance sheet, which we'll take from our model, and then we'll have this immediate adjustments for transaction, and then we'll have a new balance sheet. So the real change, the only change on the asset side that we'll forecast is intangible assets. Cash could be impacted if we used it, but we will not. So intangible assets here, it's a big number. What it is, it's effectively goodwill. Goodwill, it's an accounting concept, but what it is, it's excess of a purchase price in the deal over book value of equity. So the formula is actually very simple. We'll take equity purchase price minus net book value of equity. And here for Home Depot, it's a little bit interesting because their book equity value is negative. So the adjustment here is actually even greater than the equity purchase price itself. On the liability side of the pro forma balance sheet, we will be adjusting debt. So we'll assume that the debt in the deal is long-term, just for simplicity. Revolver could be counted as short-term, but the rest of the debt will be long-term. So in that long-term debt adjustment, what you see, and you see that in short-term debt as well. So you basically remove all prior debt. It gets refinanced in the transaction. So the old debt holders get paid off, and then you put on new debt. And new debt comes from sources table. So again, minus old debt plus new debt. So that's the adjustment. For common equity, there's a couple things there. So you remove old equity. So Here again, it's a little bit unusual that the old book value of equity is negative. So when you remove it, your equity goes up. And then you also increase equity by the equity injection from private equity firm. And then minor thing, but you subtract all the transaction expenses from retained earnings. And the way pro forma balance sheet gets incorporated, this is a page from the model that we've built. Hopefully it looks familiar to you. But what I did here, and this is mechanically a lot of work for today, it's probably where most kind of tedious and most mechanical part comes in. But what I'll do in Excel, I'll create a new column in the model here called pro forma between year 2021 and year 2022. So I'll literally like put in a new column, but then I have to adjust all my links. And this is kind of the more impacted part. So in the balance sheet, so pro forma column replaces old January 2021 column. So like all my forecast for the balance sheet has to be based on this new pro forma column. And the impact on income statement is very small, but on the cash flow statement, we'll have to make sure that we're using the right period. So we'll have to manually adjust all the lines for this new column. So that's where there's a fair amount of manual work involved. And I'll spend much more time in Excel, so you'll understand how it all works. I just want to make sure conceptually you're prepared for what you'll be doing. So we'll build sources and uses, create pro forma balance sheet, and then incorporate pro forma balance sheet into the main model. For all the financial statements. Also, we will have to redo the debt schedules because the debt will be completely different. So that's manually where most of the work is. And then at the very end, once we're done with that, we'll calculate the IRR, which is the final goal for this exercise. So here's what IRR will be based on. The major driver for IRR will be the sale of the company at the end of the holding period. So we'll assume that 5 years later, in January 2026, Home Depot gets sold again. Could be IPO, could be another private equity firm that buys it. And we will assume on exit, same multiple of EBITDA. So there's no really financial kind of engineering happening. So we will assume that from the valuation perspective, when the business gets sold for a very similar price as it was bought, right? So it's not like, the multiple expanded or, the buyer was able to get more money on sale. They will get more though. The purchase price will be higher, but it'll be just a function of higher EBITDA, which is better performance of the business. And the next big factor is pay down of the debt that was raised during the IPO process. So that's really why we have to rebuild the entire financial model to see what will happen with the debt raised in LBO. So in this total debt number, 90 billion, we'll take that from forecasted balance sheet. And same, subtract cash to calculate equity value on exit. And remember, we had 3% assumption going into unsecured lender, and then 97% goes to private equity firm. So here we'll take 97% of the equity proceeds on sale 5 years later. And in this calculation, basically the initial outflow for private equity sponsor is their equity purchase price. That's in year 2021. For simplicity, we're not going to assume any dividends, but you could have them. And then on sale, again, nothing happens until when you actually sell the company. And that's when you get this number I just talked about, 620 million for 97% of equity. And then we'll just calculate IRR in this, like in Excel using IRR formula. And here you'll see 18.7%, which is actually a fairly good number given that Home Depot is already valued very highly. You know, that actually puts limit on the amount of leverage that you could put on a Home Depot. So it's actually a fairly good return for a company like Home Depot. Well, that's it for the introductory part. And now let me switch into the template that you have. And the template really, like, let me talk about how I came up with a template. So the model and estimates tab is exactly what I covered in the prior two classes. So I haven't changed it yet. I will change it in a few minutes. But I just kind of wanted to make it easier to follow. So I created templates for sources and uses and pro forma. Sources and uses is more just kind of labels. So there's, you know, I like how it's laid out, but, you know, I didn't want to spend time typing in all the numbers, but there's nothing kind of, you know, nothing unusual happening here. On pro forma tab, I did link it. So if you were doing it from scratch yourself, you would need to replicate it. But again, I just wanted you to be very clear on what I've done. All it is just, you know, headings for balance sheets. So all the standard balance sheet items, which originally we took from FactSet. And then I linked it to the column for January 2021. SA stands for standalone. So it's whatever we had in the model. So I just linked it in column C here. And then we'll do the adjustments together. And then pro forma is just standalone plus the adjustment. So a fairly simple template, right? Nothing too complicated or unusual. So let's just walk through it together. A lot of these inputs we've already used in our financial model, so I'm not going to look them up again. I'll just link them to our model. So for the share price, we've compared our DCF values to the current share price when we did DCF. So I'll just take the current share price from there. So for me, it's in the model at the bottom there in row 164. And then bid purchase price will be current share price multiplied by 1 plus the premium, 20%. So it's going to be $323 per share. Number of shares I will take from the model in row 161. Equity purchase price, you know, we've done this calculation a few times. It's purchase price per share times number of shares. I'll remove the number of decimals here. So debt, I talked about it. We'll take debt from the model as of January 2021. So on the balance sheet here, the debt is current debt plus long-term debt. So 37,150, and then minus cash. It's 1,500. That was, remember, our assumption, how much cash they should have at the end of the year. And then the enterprise value would be equity value plus debt minus cash. EBITDA, this is just for reference, 2020 EBITDA is 18 billion, and the multiple, put it in the right cell here, and the multiple is transaction value divided by EBITDA. So it's 21.3. Let's do goodwill right away here. We'll need that for a pro forma balance sheet adjustment. So equity purchase price is 349. Book value of equity, and I'll just use it with the same sign. So as of January 21st, common equity is -3 billion. And goodwill is the equity purchase price minus the book value of equity. So it's 353 billion. Now we'll go to sources and uses. Equity is just linked to equity purchase price we've calculated, and we'll need to pay down existing debt. And then we'll have to pay these transaction fees. So total uses will be the sum of all these items above. So it's 387 billion. And I'll just manually link it to total sources. So we need to come up with all the money required for the transaction. So the dollar amounts are really based on these multiples, which are gave you as assumptions. Typically, they would come from banks. Banks would do their credit analysis, and that's usually based on what other companies in a similar situation can maintain, and they'll give us these multiples as inputs. Mechanically, it's very simple. It's multiple times EBITDA in cell C14. So I'll freeze EBITDA and I'll drag down all the way until total. I'll remove these borders here. So total that will be sum of, just give me a second. Total debt is sum of revolver, term loan, senior bonds, and unsecured notes. And then sponsor equity, that's very interesting. It'll be total sources minus total debt minus cash, if we had any cash. So the sponsor equity is like a plug. It has to come in with all, with the difference. So that's 242 billion, huge equity injection. And that's really when I was thinking about this example. I mean, we've kind of started with Home Depot, but really because Home Depot is already valued very highly, and you can push it just as much on the debt side, the equity is very large. So to me, it was kind of a sign that LBO might not work, but we'll see kind of what the IRR is at the end of this calculation. Percent of capitalization, that's fairly simple. Just the balance of cash or debt divided by total. So I'll have to adopt to 100. I'll remove the borders. These borders are just for you to be clear where to populate numbers. Typically in real life, you wouldn't have these boxes. So we've populated sources and uses. And we pretty much can pause here and then go to pro forma balance sheet, go through the model, and then we'll come back at the end of the class and populate the inputs for IRR calculation. On pro forma balance sheet, I've highlighted the things that you need to focus on. So cash, if you've used any cash in the deal, you would subtract it here. So I'll say adjustment would be negative cash used from sources and uses. It's 0, so it doesn't show up. Intangible assets would be equity injection. Oh, sorry, it would be the intangible asset is new goodwill. So it's just the goodwill that we calculated. And that's on the asset side. On the liability side, for simplicity, let's assume that the debt will be long-term, like we're not drawing on the revolver, which could be short-term. And then for long-term debt, I will subtract all debt and then add the total debt from this deal. Common equity is a little bit interesting here. So it'll be removing old equity, adding new sponsor equity, and then subtracting, this would come out of retained earnings, all the transaction fees. So the adjustments to assets and liabilities and equity are the same. So our check works. So our pro forma balance sheet at least balances. So we've done that fairly quickly. It may take a little bit longer if you have to think about it in real life. And now is kind of a big part of today's class, fairly manual, but let's make adjustments to the model. So I will input additional column between columns H and I. So I've pressed Alt-IC, insert column. I'll call it pro forma. And then just for simplicity, when I don't need to put in anything, I'll just kind of have a filling here for the cells. Maybe I'll just select grayish kind of color. It's just for me. So for the income statement and assumptions, I don't need to adjust anything. But for the balance sheet, I will need to do that. There's also nothing that we need to adjust, at least for the pro forma. We haven't created pro forma cash flow statement. So this one also is gray, so we're not going to put in anything in that column. So for the balance sheet here, let's manually link the balance sheet to pro forma balance sheet tab. I formatted it such that the lines are the same on pro forma as it is in the model. Let me just maybe, I think it's fine. Yeah, I'll just remove some extra values here. So we've pasted that. There's still a lot of work to be done to kind of incorporate balance sheet into the model, because right now we just insert it, it's not driving anything. But before I kind of do that, let me jump into the debt schedule, because that schedule needs to change quite a bit. And I'll just kind of work through it methodically. So minimum cash is fine. Cash before revolver. If you recall, it took the cash available for the prior year. So that one we have to adjust. And now we basically don't want to take anything from balance sheet, from the old balance sheet. We want to use the new balance sheet. So I've updated that. But then after that, it should all flow. You know, it picked up the right cells after that. So what happens to debt? Instead of short-term debt, I'll just use these schedules as placeholders. Revolver, I'll just call it revolver to match what I have in my sources tab. So I'll have revolver. I will have a term loan. I'll have senior bonds. And I will need some more space here for unsecured notes with warrants. It's a little bit extra work, but let's make it fairly realistic. So I'll just copy it format for the debt schedule and I'll call it unsecured notes, beginning balance, pay down, drawdown, interest rate. If you recall, there's two types of interest payments on notes. There's cash and there's payment in kind, PIK. So create those. Then I'll come back and populate it. So beginning balance, you know, we're just modeling the 5 years out. Beginning balance should come from sources. So revolver, amount funded is 0. I'll make it green. I don't know if I can see it there. And then interest rate should also come from sources. Interest rate in revolver is 4%. Interest expense should be calculated correctly here in the schedule. Let's see, beginning balance for term loan would be from sources and uses, 72. Pay down, drawdown. Let's recreate that and let's just make an assumption. For term loan, I'd like to basically pay down by the end of the LBO period. So I'll say they'll pay negative 1/5. Oops. They'll pay negative 1/5 of the beginning balance. And then I'll keep that flat so it really pays it down. And then the interest rate for term loan is 5%. Interest expense is calculated correctly. Just format it a little bit here. Senior bonds, let's link the balance. 36 billion. And senior bonds, let's assume that they don't They don't have any payments. I just have them at 0. And this would typically be given us by the banks along with the interest rate. So let's just keep them flat. The interest expense on senior bonds is 6. And by the way, I should be linking them, should be updating the interest expense for all periods here. So I'll just made the interest expense flat for simplicity. Now let me just copy this for formatting for the next schedule. So beginning balance of unsecured notes are 36 billion. Paid on drawdown, I'll come back to that. Interest rate cash is 0. And interest rate PIK is 8%. That's in sources and uses. Just copy the format. So what that 8% means, payment in kind, is that 8% will accrue to the balance every year. So I'll calculate what that 8% is. Average and then for accrual, I'll basically be adding that amount to the balance. You know, I think for PIK, the formula is a little bit different. Actually, it's not based on average. It's based on the beginning balance. Because, you know, that's how these contracts work. It's kind of hard to expect more interest. Let's just base the PIK on the beginning balance. All right, so I've kind of set up the debt schedules here. I don't think I need these old numbers here. Well, I mean, they're still driving something. Let me keep them for now, but I'll kind of, let me mark them yellow here. I would like to get rid of them, just kind of have clean calculations. All right. So let's start with balance sheet and check every formula for January 2020. So cash is coming from the ending cash, that's fine. Short-term receivables, they're based on days accounts receivables and revenue, that's fine. Inventories are the same way. Current assets are also based on that particular period. But here's the first instance where we need to adjust. So we were using old net plant property and equipment. So no impact really on the numbers, but let's just change the formula here. So what I'll do, I will shift the formula from January 21st to pro forma, and then it still adds depreciation, subtracts depreciation, adds capex. Intangible assets, same way. I mean, it will be fairly manual here, so I'll just shift the formulas from old balance sheet to new pro forma balance sheet. Right, so this needs to be shifted. Short-term debt and current portion of long-term debt. Let me just link it to revolver 116, and then the other debt will be long-term. Accounts payables are fine. Income tax payable, that needs to be shifted to new pro forma. Long-term debt, let's see, where does that come from right now? So it comes from, it just takes senior bonds. So we need to add term loan, revolver be included in short term, and unsecured notes. It's our long-term debt. I'll draw the formula, I'll extend it. Deferred tax, I will relink. Other liabilities. Common equity as well. All right, so the balance sheet doesn't balance yet because we haven't built the cash flow statement. Net income is fine, depreciation is good. Changes in working capital, that's where we need to change the formula. So again, instead of using old pro forma, old number, we need to use pro forma number. CapEx is fine. The other rows are 0. Dividends. This was just an assumption. You know, this is not going to change. So I'll actually leave it like that. And then issuance reduction in net debt. So this needs to be adjusted. Other funds were 0. Beginning cash. Yeah, let me link it to the balance sheet here. And then changing cash is good. I went through it fairly quickly, but we are not done yet. I need to add PIK interest. So where I have non-cash items, I'll have PIK interest expense. So I'll add it back. Let me see, it's captured. So my balance sheet doesn't balance again. That's fine because I also would add that PIK interest expense to my interest expense. Okay, so the only other thing I need to do related to PIK, payment in kind, is I need to see how my debt is changing on the cash flow statement. So these numbers on the cash flow statement should be literally the cash that you pay back to debt holders. Now, payment in kind right now is captured here. So remember, our balance goes up. And right now it kind of, it assumes on the cash flow statement, because we're capturing the difference, that we're actually paying cash. So you have to subtract PIK interest from your cash flow change in debt. And I'll extend that line. And now you'll see that my balance sheet actually balances. So payment in kind introduces a little bit of a complexity for us. Let me just kind of summarize how it's treated. So we include cash and payment in kind interest in our interest expense. That goes onto income statement. On cash flow statement, we add back payment in kind as non-cash item. And then down in the financing section of cash flow statement, we subtract payment in kind interest, because when we just take the difference in balances, we would include PIK interest there, but then we will subtract it when we calculate cash flow from financing. And then I had this historic values for debt highlighted. I wanted to get rid of them, but then I realized that we actually need them to come up with January 21st estimates. So let's just kind of leave them in place here. So what we're going to use from this model that we adjusted for LBO assumptions is primarily, well, we'll need EBITDA, right, to calculate what the sale price of the company will be. We will also need cash and debt. So cash we assumed is flat, and then for the debt, we're actually incurring quite a bit of debt. Oh, one thing I should have changed, there's of course no dividends. I kind of went through it very quickly, but I should not be assuming any dividends. In LBO situation, it's very different concept. Home Depot cannot assume the same high dividends, but what they will be doing in a typical LBO situation, they will be paying down debt as fast as they can. Let's relook at that now. So yeah, their debt is kind of relatively flat for the revolver part, and then otherwise it just keeps going down. So instead of paying dividends as Home Depot did before, they'll be working on paying down the debt. We can now go back to sources and uses and calculate IRR. So initial equity investment will be negative sponsor equity. And as I mentioned, there's no dividends. Proceeds from sale, let's populate it here on the left. I see initial loan is also clear. Okay. Yeah. So EBITDA in 2025, that should be the last year in our forecast. That's 24 billion. And then let's assume that they sell the company at the same multiple. So transaction value would be EBITDA times EBITDA multiple, 522 billion, less total debt at the end of our forecast period. So let's say negative, go to the model, take short-term debt and long-term debt, and then plus cash in the model is 1,500. I'll just put in some number here for transaction expenses, and equity value would be the total transaction value or enterprise value minus debt plus cash minus transaction fees. And then 97% of that goes to sponsor. So it's 1 minus 3% that goes to warrant holders. Warrant holders get 3%. So equity to sponsors is 97% of equity for 410 billion. And then equity to unsecured lender is 3% of equity. And I had, okay, initial loan is linked. So let's now look at total cash flows to sponsor. So proceed from sales. So that's 410 billion. And then cash flows, I'll just basically sum up. Dividends, initial equity, and just for the IRR formula. And then IRR will be IRR in Excel. Highlight the values. I guess we've got to guess, maybe 0.2 would be good. So it's 11% IRR. Fairly low, but that's really a function of high purchase price and relatively low leverage that they could put in. For the lender, on exit, they will have principal of their debt back. We'll go to the model, find unsecured notes. So with accumulated interest, they'll get 53 billion back. And then they'll also have 3% of equity, which is 12 billion. So let's add that up. And then calculate IRR. It's 12.7%. So the IRR is calculated based on the exit sale price. We'll calculate that as EBITDA in the last year of the forecast times the same multiple as was on the purchase, and then that way we'll get transaction value, subtract the debt, add cash, subtract transaction fees. That'll give us equity value, and then 97% of that will go to sponsor, 3% will go to unsecured lender, and IRR is actually calculated based on the two numbers: the initial outflow, which comes from uses table, the initial equity investment there, that's our outflow, and then the inflow will be the equity to sponsor in the final year of the LBO period. Well, that concludes our LBO class. I hope you enjoyed it. I know It can be difficult, especially in Excel with all the small adjustments that I did to the model. Hopefully you can follow that, and I look forward to meeting you in the class.